Welcome to the Alan Berry Reports TV. I'm your host, Alan Berry Laboucan from AlanBerryReports.com. Well, it's the last show of the year, and this is the show that we always sort of save to do our review of the previous year. One of the projects that we do every year, well, for the last few years anyways, is an outlook for the year ahead. And at the end of the year, we do a review. The reason we do that is a lot of people put out predictions at this time of the year. Not so many review and assess how they did with their predictions of that previous year. And we always feel that it's easy to make predictions. It's much more difficult to take ownership for those predictions at the end of the year and sort of assess how you did. And so we like to do this every year. We've been doing it for a number of years. We're going to be doing it again on this show. We're still a few minutes. Oh, actually, the markets have closed. So the numbers that we're going to be using are the closing prices for the year for many of the assets that we cover and markets that we cover in this report. So that was one thing we wanted to talk about. Also, the reason that we do the outlooks is it helps us stay focused on the big picture. And, following the big picture is a really great way to sort of handle when the markets are highly volatile and keep you focused on what's important. And this way, it makes it much more likely that as an investor, you make intelligent decisions and not emotional decisions. And so we like to stay focused on the big picture, and that's why we do these annual outlook reports. So having said that, I'm going to I've got with me here the Outlook 2011 report, which went out on January the 11th, which was our 29th in our 29th edition of our written report. We also did last year the Outlook 2011 shows as well, and so actually that's the way we're going to be doing it this year. We're only going to be doing shows for the review and the Outlook 2012. Recently we started doing our own private written reports to subscribers, and so we're not going to, all of our key writing on the trends and stuff will be in our private reports. But nonetheless, we're going to be continuing to do our shows, and we've got a lot of exciting shows set up, and for the 2012. And one of those shows, the first show of the year, will be our Outlook 2012 report. So we look forward to having that report out for you all. Having said that, one of the key things that the report started out by mentioning was that we formalized our year-ahead outlooks back in 2009. That was our first year. Then we did an Outlook 2010, and we had exceptionally good results, those two, in Outlook 2009 and 2010. And in fact, the results would put us in the top level of our peers. In fact, we're not aware of anybody that had as successful picks or calls in the various different assets that we cover. And so we challenged people in the past. We'll challenge them again to find anybody that had as good of results in Outlook in their Outlook reports of 2010, 2009, and we hope to do that in 2012. And so we'll get right into it. I've got a bunch of websites open here so I can talk about these various different market calls that we made. We always start out with the stock markets, and the first stock market that our index that we follow is the Dow Jones Industrial Average. Just pulling that up right now. So why we follow the Dow Jones Industrial Average is no matter how big or small a company is, that is one of the most focused on when people ask you, well, what's the stock market doing? That's usually the barometer of what people talk about. And it can also have it also has an influence on a lot of the sentiment towards the investor sentiment. So we keep a close eye on that one. And we had an opening paragraph with some reasoning. We can't go into all the reasonings for those. We'd suggest to you that you could check out the Outlook 2010 show. In that, look above me on our website, you'll see an ABR TV guide. In there we have all the past shows. Just look for the Outlook 2010 show. But we did wrap it up by saying, due to the market rally getting stretched, at that time there was a market rally that we thought was getting stretched. It looks like the market is primed for a pullback in the 5 to 10% range. After the pullback, we think the market will move into a more positive trend throughout the remainder of the year. And our call is for the market to finish the year around 12,500 points. So, having the big correction that, first of all, we started out the year at about 11,700 points on the Dow. It got up to as high as close to 12,000. What was the yearly high? 12,928. So almost 13,000 points. There was a few corrections. One was a fairly healthy one from around early May until about the end of June. Then there was a rally followed by a pretty serious correction in the summertime. This summertime this year was a pretty challenging period. There was a lot of volatility due to what was going on in Europe. And this caused the stock market to take a pretty big punch in the nose there and drop from around 12,750 all the way down to 10,650. So that was a pretty healthy pullback. And then the market sort of went sideways until late September and ended the year on a pretty good rally that took it from that 10,650 level all the way up to today, when it closed around 12,217 points. And so, it's within a few hundred points of the price that we called for. I think we got the main trends and the prices right. So we're going to take an A plus for that score on that one. The next market that we follow closely is the S&P 500. Why we follow the S&P 500 so closely is that it is a broader index. It covers 500 of the largest companies, and I just forgot to pull up a chart of that. They're probably everywhere, and I just can't seem to find one quickly enough here. What I'm going to do is just bear with me for a brief second, and I'll get an S&P 500 chart. There we go. We should have something come up here fairly quickly. S&P 500. Let's see here. Hopefully this one will give us a range for the year. Yeah, here we go. So we started the year right around, let's say, 1,280 points. We'll start with the call. We were expecting that, much like it always does, the S&P 500 to follow fairly closely what the Dow Jones Industrial Average does, and we were looking for a year-end close somewhere around 1,400 points. The trend very similar to what we were looking for with the Dow Jones Industrial Average. Same kind of rallies followed by pullbacks, rallies, pullbacks. Market basically went pretty much sideways for the year. We were about only 90% of although the market did get close to that 1,400 point level earlier, about midway through the year. It's now closing somewhere around 1,257 points. So we've got pretty much got the trend rate on that, but we're off by about a little over 10%, let's say 12%. From the number that we called, even though it had hit that number. So on that one, we're going to take a B minus for that mark on the S&P 500. The next index that we're going to talk about is the Toronto Stock Exchange. We're very bullish on commodities, and we follow the Toronto Stock Exchange as well as the Toronto Stock Venture Market. And the reason we follow those two is the Toronto Stock Exchange tends to follow what's happening with commodities and with the biggest, the large cap commodity type companies. And then the TSX Venture Market is more about the smaller explorers, the high growth kind of companies. And so we follow those both. We were looking at the Toronto Stock Exchange. We were looking for a bullish market. We got a bullish market in the early part of the year. It didn't go near our market high. We were looking for a high of about 16,000 points. We were expecting a very strong rally, especially in the latter part of the year for commodity prices. But due to the situation with the Europe, it really was the fly in the ointment that affected that price call. And so we started out bullish. We ended up with a correction for most of the year, then a correction and then a sideways market for a while. It's closing somewhere around 12,000 points, so significantly off of that number. Some part of the year we were correct, some part we were wrong. We're going to give ourselves a C mark for that market call. The next one was the TSX Venture Market. Again, many of the same reasons that we were calling for a bullish call. We were looking for a late year strong market for commodities. We didn't get that. A lot of that's due to what happened in Europe, and we were nowhere near our high for the venture. In fact, it's only about halfway there to the 3,000 point level that we were calling for. And again, a lot of that we think is due to what happened with the price of commodities, and that was affected by what was going on in Europe. And so on that one, C minus for that mark. So we hit a couple of the Dow and the S&P pretty accurately. We're very underperformed in our calls on the Toronto Stock Exchange and the TSX Venture Market, and so on a market from the stock market sense, we got a passing grade on that one. So now we're going to move into commodities, is what we do every year. We start out with the indexes in the Outlook reports, then we move into commodities. So the first commodity that we talk about is gold. And for gold, again, we started out with the rationale behind our calls. Don't want to go into that because it'll take too much time to do this report today. Our synopsis and call was for gold to continue its long-term bull market trend, and we were looking for a year-end close in the $1,700 per ounce range, and that's U.S. dollars I'm talking about. It'll be U.S. dollars that I talk about with all of these commodity prices. We've got a few that we're going to talk about, and so. What happened with gold? Got to pull it up here if I can find it. Where is my gold chart? Sorry for a bit of the delays here. We're kind of, I know where I put it. Right there. Okay, just moving around things. So we started the year around let's say $1,400 per ounce. Then it went into a very solid bull market. that led to almost $1,900. Well, it did hit $1,900 on the high in August, and going into September. It was very strong. Then, like everything, got beat down with what was going on with the Eurozone. Kind of had a sideways month there, 3 weeks in late September, early October. Then there was a rally that popped it back up to 1,800. Then more worries about Europe. I think in profit taking took it down. Sort of had some consolidation towards the end of the year, and we closed right around the $1,600 per ounce range. We're going to give ourselves an A mark for that. We totally hit the trend rate. We almost got the number right. It was within striking distance of our number. It actually exceeded our number for a good portion of the year. Probably 3 months of the year, it was well over that 1,700 range and hit as high as 1,900. So we're going to take an A. If it had closed around right on the number or close to 1,700, we would took an A plus. But we think a fair mark for the gold price call is A for that one. So now we'll move into silver. On the silver market, many of the fundamentals that move gold also move silver, and so we were looking for a similar trend. So what we closed was last year. Silver entered a very bullish trend, and our call is to see that bullish trend continue, and it very much did for the first, let's say, half of the year, and actually was very strong. We were looking for a year-end close around $40 per ounce. So what happened here was we started the year very strong. There was a very strong trend from January to let's say mid-April. The price actually hit almost $50 per ounce. So it significantly exceeded our $40 number. Then there was some profit taking, as was pretty reasonable. There was also some other factors. There was a change to the margin requirements for currency or for silver traders, so that affected things. It came down. Then it found support fairly close to $40, between $35 and $40 for about all of May, all of June, all of July, or into July. Then there was a rally that brought it back up to that $40 number. It trended sideways around $40 for from July to about the first couple weeks in September. Everything got sort of beaten down then in September with all the euro worries, and that consolidated the price down, and it closed around $30 per ounce. So even though it's significantly off the year-end high that we were looking for, the price trend was right. We were right on the money. We did see a very bullish trend. It spent a good portion of the year between $35 and $45. We think that this is a very successful call. We're going to give ourselves a B plus because it didn't quite. It's off from that. It's trading at around $30 right now, so it didn't end the year like we thought it would. So we're going to take a B on, maybe even a B minus on that one. We do like the number we had talked about, the trend. It did those things earlier in the year and for about the first 9 months of the year. Then the last quarter was not that great, so we'll take a B minus for that one. So the next commodity that we're going to talk about is copper. And in the call for copper, we mentioned that in 2010, copper was one of the star performers in the commodity space, and 2011 is shaping up to be another strong year for the price of copper. We're looking for copper to reach $5.50 per pound before the end of the year. So the highest it got was around $4.50. significantly off of that high that we were expecting. We kind of got broadsided on that call from the economic turmoil in Europe and other places, and copper did not reach the levels that we were expecting it to in the last quarter. Well, I don't think I need to remind people what sort of has been causing that. So on the copper, we didn't see we seen for the first 9 months of the year basically seen a sideways trend. That just didn't do anything, had some rallies, this sort of action, and then fell out of bed. And then once it fell out of bed in September, it sort of found a level around the 350 mark, which is pretty close to where it's trading at today. On that call, we're going to take, I guess we'd have to say that one, we didn't get the trend rate or the price. We're going to take a C- on that one. On the next commodity, and I think that's the final commodity that we talked. Oh no, we also did uranium. So we'll start with we'll do our oil call. So we were looking for a solid market for the price of oil. Our call was for oil to be in a bullish trend during 2011 that takes the price significantly higher, and we felt that it would reach a high of $110 per barrel before year end. What we got was the bullish trend was definitely there. It started the year at around $91.55 per barrel. It hit as high as $113 per barrel, so right around the number we had called for, and it's ending the year at about $100 per barrel. We hit the trend rate, we hit the prices rate, we hit the high rate. We're going to definitely take an A+ on our oil call. The next one was uranium. Just going to pull this up here. Where's my uranium price? So uranium started the year, I'm going to say somewhere around, let's say $65 per pound of U3O8, which is the going market price for uranium. Then it had, we'll start with the call. We're very bullish on the long-term fundamentals of uranium and think that it has the best supply-demand fundamentals of all commodities we follow closely. Our call is for a continuation of the bullish trend that got underway last year and a high over $110 per barrel or per pound by year end. So what happened was we got a high of about 74, somewhere around $74. It really fell into a lot of trouble for the price of uranium when they had the nuclear. It started out with the earthquakes in Japan, followed by a disaster at the meltdown at the Fukushima nuclear plant in Japan. This really punished the price of uranium. Nobody can be expected to be able to predict catastrophic earthquakes that cause catastrophic issues with the uranium power plant. We definitely would give ourselves a D for the uranium call, and we still think strongly about the fundamentals of supply and demand long term, and we're going to make our call for the uranium price in our Outlook 2012 report, but we'll definitely take a D for our results on the uranium call. The next thing we moved into, I'm just going to close down another screen here. The next thing that we talked about was the bond market. We've been wrong on this call for a few years now. We thought that, buying bonds that are yielding less than, if you take into consideration inflation, is not a thing that we're too excited about. And we think that somewhere along the lines, and we've been wrong on this for a couple of years, that with the abundance of supply and suspect demand, the demand was basically coming from the Federal Reserve. We think that sometime there's going to be a fairly significant correction that drives yields up, but we've been saying this for a few years, so definitely wrong. Let's see, our final close was, it also looks the market feels that the Federal Reserve is not going to be a big buyer in the debt market for much longer. Towards the end of the year, it looked like we were, at the beginning of the year, it looked like that long-term wrong call that we were making is going to be correct, but we then went on. Our call is for a weaker trend for bonds that started in late 2010 will continue and put additional pressure on bond prices. This didn't happen. They stayed buoyant. Definitely wrong again. We think that is going to, when that trend breaks, the bonds are going to take a lot of punishment and yield's going to go up significantly. Like I said, we've been wrong for a long time, but when that happens, we do think that that's going to be a pretty significant return for those that are short bonds. Next thing we called was interest rates. We're expecting that close to zero chance that the Federal Reserve would do anything on interest rates, and that was exactly correct. That one was probably an A+ call, but it's such an easy call that we're going to take a B on that one. B+, okay. And the final thing that we talked about was the U.S. dollar. And in the U.S. dollar, we think that it's much like the bonds. Ample supply, abundant supply, suspect demand. We don't like the U.S. dollar. We think that our call was we're concerned about the poor fundamentals for the U.S. dollar. Our call is that the currency investors will get better performance holding commodity currencies like the Canadian dollar and the euro dollar during 2011. So we'll start with the euro dollar. The euro started somewhere around, let's see here, 2011. Started somewhere around 1.30 against the U.S. dollar, got to as high as 1.48. That was a very spectacular move. In fact, for the first 9 months of the year, we had, again, started at about 130, peaked at about 147, going into September, late August was still trading at 143, so that was an exceptional return. Then things started to take it on the chin, and closed because of the euro worries, closed the year somewhere very close to where it started the year. So for 9 months of the year, that trend call was spot on. It exceeded all our expectations. We're going to take a B- because we got the trend right for most of the year, and ended up the last quarter really took it on the chin, but still for 9 months of the year, anybody owning the euro over the U.S. dollar did very well. The Canadian dollar started the year right around even par, 1-to-1. It had, and then it trended pretty much sideways for most of the year. The low end was somewhere around 95. The high was around 105. It's currently trading a little over par, the U.S. dollar is a little stronger, about 101. So it was pretty much a sideways trend on that one, and so it was a wash. Not even worth putting a mark on how it did with the Canadian dollar. If we would, we'd say it's a passing grade of about a C or something like that. So then, one of the things that we do, in addition to making these market calls, the bulk of the work that we do is we talk about stocks that we pick and feel are going to do well. And one of the litmus tests of how well we do that is the fact that we've picked about 48 companies over the since we started the report in 2005. And as of this year, prior to this year, we had 6 companies that were taken over by much larger companies at premium prices. We put those companies into what we call our Hall of Fame. And because the end game for a resource company, the small exploration companies that we talk about, is to either find something significant that either is bought out by a much larger company at a premium price, or turn it into a mine. And so far, we only can put the Hall of Fame as companies that get taken over. And this year we had 2 more companies join the Hall of Fame, if you will. One company called Peregrine Metals was bought out, and then Hathor was bought out by a major mining company as well at a that one was maybe one of our best picks ever. I think we started covering that company when it was trading at about 60 cents, and ultimately it was bought out for about $4.70. So that one may be one of the best picks we've ever made, as far as the getting in early and selling at a premium price. We could add a few companies that to the Hall of Fame that have went from making a big discovery to now being producers. We haven't formally done that yet, so what we say is about 20 to 25% of the companies hit the end game that we're looking for, and that blows out of the water any of our peers that make these kind of market calls. And so we're very happy with the main thing we do is look at trying to find stocks. And so, that's our ultimate thing. And so on our stock calling, even though it was a very challenging year, we've had some really good performance. And if you take into consideration what's happened with the indexes that we talked about earlier, the Toronto Stock Exchange and the Toronto Stock Exchange Venture Market, a lot of our picks significantly outperformed those markets. And so that's what we're trying to do, is make good stock picks, and we had another good year on that front. So that's sort of the review of our 2011 outlook. Got a couple of before I wanted to close, there's a couple things I want to let you know about. Next week we're going to be doing our Outlook 2012. So if you're a subscriber to our email list, there's no charge. That's free. We send out notices whenever we have reports out, whether those are free shows that we do, or when we're offering our private reports. We send out an update on our email list, and again, that's no charge. So if you're not already a subscriber, we encourage you to join if you like what we do with our market calls and our stock picking. If you're interested in our private reports, there's look above me. There's a shop section. By the way, if you want to subscribe to the email, just look to my left on the website. There's a box there that you can join, or on the bottom left of the website, there's also a box there that you can join our email list. Private reports, look at the shop section. You can see the private reports. So far, we only started this in mid-December. We've had or late December. We've had one report out so far. You can either buy that individually, that's one way, or the best value and the quickest way to receive the reports is to do a yearly subscription, and that's all set up in our shop section if you want to purchase the individual reports or the yearly subscriptions. So, as I mentioned, sign up for our emails and you can find out about all the work that we do for no charge. So, that's our wrap up on our year in review show. Before closing, I'd always like to stress that this show and our reports are for information purposes only. We aren't making buying or selling recommendations. It's important for you to do your own research and speak with your financial advisors before making any investment decisions. We always like to say thank you to those that make this show possible. We use youtube.com as our website or our platform to produce and broadcast these shows. For anybody that is interested in doing shows, we highly recommend YouTube. We love to watch videos. That's why we do these videos. We like this kind of interaction, and so you find millions and billions of videos on YouTube, and so check them out. Also, if you look to my left on our website, you'll notice that over there we have some banner sponsors. Those banner sponsors are really important in us being able to do the work that we do. If you want to learn more about those companies, just click on their banners. It'll take you directly to their websites where they have plenty of information so you can do your homework on those companies. And of course, to you, the viewers, without you, we wouldn't have a reason to do the shows, and we really appreciate you tuning in. So thank you very much. We hope that you've all been enjoying your holiday season and getting a chance to visit with your friends and family and loved ones. And that's what this season is all about. And we wish you all a very happy and prosperous 2012. On that note, we hope to see you soon on future shows. Tune in. We'll talk to you soon. Have a great day and a happy and prosperous 2012.